What's up, guys? In this video, I'm just going to be going over what are breaker blocks. Very simple concept. It is essentially the same thing as an inverse supply and demand if you came from EP's course or EP's trading system. So I know I say this every video, but without any more words being said, let's just kind of get into it. So what is a breaker block? So a breaker block is essentially just a failed order block or a flipped order block. It's a flip zone. So like I said, if you ever came from EP's course or EP's system, if you were aware of what inverse supply and demand was, and breaker blocks are essentially the same exact thing. You don't really have to look at them as anything different. The only thing that changes with them is what makes them valid. And it is the same thing as the normal order blocks, where when we have lower prices or higher prices, we just need them to get closed underneath or closed past to make it valid. So if we just go into a bullish example over here, or a bearish example over here on the left, right here, we had this bullish order block, which is these red candles, the last sequence of bearish candles before the move up. This was a bullish order block. This order block failed to hold, and we ended up closing underneath it with a lower price. This makes this a bearish breaker block. So essentially, if price were to return back into here, because of the fact that this didn't previously hold to the upside, we can expect price to retrace into here and continue to the downside. Opposite way with a bullish example, right here, we have this bearish order block right here, which is this last set of bullish candles before this move down that closed underneath with a lower price. Right here with this bearish order block, and it failed to send price lower. And we ended up closing above it with a higher price. What this means is this is now a bullish breaker block. So I can get rid of that. So one thing I will say with breaker blocks is that it is completely up to you if you want to include the wicks or if you do not want to include the wicks. I will say I personally, most of the time, do not include the wicks. I'm most of the time just looking at the bodies of the candles, and that's really just what is the most important to me. But essentially, like I said, it's very simple, and it's the same thing as an inverse supply and demand zone. It's essentially just a failed order block turning into a flipped zone. If you expected a bullish order block to hold bullish and it gets closed underneath, you're essentially just expecting it to be a bearish order block type of thing. It's just a different name for it. So obviously, now that I've shown you guys these couple examples, I could probably show you guys a normal chart example here. Yeah, so right here. Right here, we had this one candle up before we had this move down, right? So right here, this is a bearish order block, right? When price fails to hold and send price to the downside off of this order block right here, and when we close above it, which we did right here with this candle, now this right here is now a breaker block. So this is now a bullish breaker because it failed to send price down to the downside, so now we expect it to send price to the upside. So right here, if I look a little closer, we can see price gave a green candle and closed above this breaker, retraced back into it, and gave another bullish move. So right here, this was a clear example of this bullish breaker being used. But they will not always play out, like right here. Right here, we have this move up before we had this move down, this big expansion down. Right here, we closed above this right over here. So I could mark this out as the bullish breaker. But we can clearly see price did not want to hold from that level. Price had to, dig a little bit deeper into the price range, a little bit deeper into equilibrium. If I mark that up, a little bit deeper into equilibrium just to make its move back up. So they will not always hold, like every single other confluence in the market. You're not always going to see a 100% success rate with it. But this is the way that you can use them to your advantage. They appear everywhere. Say just keep it very simple. If I was on an hourly time frame right now, this is what I would be looking at, right? We had these candles up before this move down. We also had these candles up before this move down. So right here, we have this bullish breaker, and we have this bullish breaker right here, right? Both of these blue lines are bullish breakers because we have closed above both of them with a higher price, and we failed to send price lower. So these are now bullish breaker blocks that we can expect to hold price to the upside, with this most likely being the next draw on liquidity. So that is what breakers are. They are very simple. It's just essentially the opposite of an order block. If a bullish order block fails to hold to the upside, it will most likely print to the downside. Vice versa for a bearish one. If a bearish order block fails to send price lower and we close above it, it will most likely send price higher. So very simple, definitely something to backtest and learn. And if you have any questions, let me know.